So if you were watching the charts over the last 24 hours, you probably felt, well, a very specific kind of tension just leave the room.
Oh, yeah, definitely.
Because it wasn't just a regular price bump. Bitcoin reclaiming the $68,000 level, it really feels like a structural shift.
Yeah, it's not just a technicality.
Right. We aren't just looking at, a few green candles on a screen. We are looking at a reclamation of this massive psychological and technical battleground.
It really is a reclamation. And honestly, battleground is exactly the right word for it. I mean, traders have been fighting over this specific zone for weeks now.
Blood in the streets kind of fighting.
Right. Winning this territory completely changes the map. But what's super interesting in the sources today is that, well, while the floor definitely feels higher today, the ceiling is...
The ceiling is complicated.
Highly complicated, yeah.
And that's exactly what we are here to figure out for you in today's deep dive. We've got a stack of research and sources that paints a pretty complex picture.
Yeah.
Because it's not just the classic, number go up narrative.
No, not at all.
We're looking at a collision of three massive, massive forces here. You've got institutional capital just flooding back in through the ETFs. You've got a completely new federal regulatory playbook dropping with the Genius Act. And then
the macro layer.
Exactly, this looming geopolitical shadow coming out of the nuclear talks in Geneva.
It's basically a classic push and pull scenario. The internal market structure, like the flows and the new regulations, it's incredibly bullish, it's pristine. Yeah. But the macro environment, specifically the geopolitical risk, is acting as this heavy lid just sitting right on top of it all.
Let's start with that internal market structure first, because that recovery was sharp. I mean, we climbed from 66,000 all the way up to an intraday high of 70,000 before finally settling back around 68,100.
A $4,000 swing.
Right, but looking at the trade data in our notes, this did not look like retail FOMO. This wasn't, regular people checking their phones on a Tuesday and panic buying.
No, the speed was way too precise for that. This was pure algorithmic demand.
Bots,
exactly. When Bitcoin breached that really stubborn resistance level at 65,800, it basically triggered a cascade of automated systems. You had natural language processing bots and high-frequency trading engines that just immediately recognized that the sell-side liquidity was thinning out.
Basically, the sellers vanished, and the machines just realized the door was wide open.
And they ran right through it. They executed all these aggressive stop-buy orders in milliseconds. It's also worth noting, and this was in the data, that the VIX...
The volatility index for the broader stock market?
Right. The VIX cooled down to about 19.5 at exactly the same time. That basically gave these algorithms the green light to treat Bitcoin as a risk-on asset again.
Okay, so the algorithms drove the bus. But I was looking at the quantitative models in the research, and this concept of the true market mean really jumped out at me. The models are actually placing the true mean all the way up at $79,000.
Yeah.
Which means we are still significantly below that level.
We are. And that $79,000 level is the critical dividing line.
Oh, yeah.
If you want to understand the market right now, think of it in two distinct phases. You have compression and you have expansion.
Okay.
Below 79,000, which is obviously where we are right now, we are in compression. The spring is coiling, energy is building up under the surface. If and when we actually cross that mean, that's when you enter the expansionary cycle.
That's where the fireworks happen.
Exactly. That's where those parabolic vertical moves tend to happen.
So we're still in the coiling phase,
Right.
But there is a very heavy weight holding that spring down. The on-chain analysis we have shows that 45% of the circulating supply, which is nearly 9 million Bitcoin, is still underwater.
That is the big, sobering reality check here. 9 million coins are currently held by entities or people who bought them at a higher price than what they're worth today.
They are sitting on massive unrealized losses.
Right. And that creates what we call overhead supply.
Because human psychology kicks in.
Exactly. When the price finally crawls back up to their personal break-even point, a huge chunk of those people are going to sell just to get out with their shirt. They just want the pain to stop.
So that creates a literal wall of resistance every single time we try to push higher. We have to essentially chew through all of that investor regret before we can really fly.
That's the perfect way to put it. Chewing through regret.
Well, the good news is we might actually have the capital to chew through it right now. Let's shift gears and talk about the institutional flows, because February 25th was a monster day. $506.5 million in net inflows to the U.S. spot ETFs.
Just a massive reversal. I mean, remember, we just sat through 5 straight weeks of bleeding. Nearly $4 billion completely left the funds over that period. To snap that debilitating streak with a $500 million day, it changes the entire narrative overnight.
And it wasn't spread evenly at all. BlackRock's IBIT ETF took the absolute lion's share, almost 300 million of that total. It really shows a flight to quality.
Oh, absolutely.
The big allocators, they aren't messing around with the smaller issuers right now. They just want the most liquid vehicle on the market.
But, you know, the most important detail here isn't just the sheer amount of money, it's the type of money. We are seeing a real-time transition from fast money to slow money.
I saw that exact distinction in the report. So the fast money refers to the hedge funds and the prop desks that were dumping in Q4 of 2025.
Right. They were just playing the volatility.
Yeah.
They caught the wave, and then they exited. We estimate they sold off about 25,000 BTC. But the thing is, that selling pressure is exhausted now. They're out.
So who's stepping in to buy the $500 million?
It's the registered investment advisors, the RIAs. It's the fiduciaries, the pension allocations. This is the slow money. They do not buy to flip it next Thursday. They buy to put it in a vault and hold it for 10 years.
Now, whenever we discuss these huge ETF inflows on a deep dive, you inevitably hear the same criticism. People say, well, if $500 million came in on a Tuesday, why didn't the price go up 20% instantly?
The paper Bitcoin argument.
Exactly. People call it paper Bitcoin, implying that ETF flows don't actually impact the real spot market. But our notes today really dig into the role of authorized participants, the APs, like Jane Street.
Yeah, this is a market mechanism that gets so heavily misunderstood. The job of an authorized participant is essentially to be a massive shock absorber for the market.
How so?
Well, think about it. If $500 million of raw, unhedged demand hit the spot crypto market directly in one single hour, the price would explode parabolically.
And then probably crash just as hard 5 minutes later.
Exactly. It would be an absolute mess. Liquidity would vanish.
So the APs step in to smooth out the ride?
They do. They use highly complex arbitrage strategies. They use derivatives and internal ledger netting to fill those massive orders efficiently over time. They dampen the volatility. So instead of a wild 20% spike that wrecks the order books, you get a steady, sustained 5% climb.
But the demand is real.
The demand is entirely real, and the actual Bitcoin is being purchased and custodied, but the market impact is deliberately spread out to prevent total chaos.
So it's the difference between a flash flood and a controlled irrigation system.
That's a brilliant analogy, yes.
All right, moving from the internal market mechanics to the actual rules of the game, we have to talk about the Genius Act. This has been a buzzword floating around for a while, but on February 26th, the Office of the Comptroller of the Currency, the OCC, dropped a 376-page proposal to actually implement it.
And it is dense.
It is the first real federal mandate for payment stablecoins.
And it is incredibly comprehensive. This isn't just light guidance or suggestions. These are hard federal rules. The biggest headline here is the backing requirement. It mandates a strict one-to-one backing.
Meaning, for every digital dollar issued on a blockchain, there must be a physical dollar or equivalent.
Exactly. There must be cash or U.S. treasuries sitting in a highly regulated vault. No commercial paper, no algorithmic backing, and definitely no fractional reserve games.
They also added a pretty strict liquidity requirement, too, the T+2 redemption rule.
Right. If you hold a stablecoin and you decide you want your actual dollars back, the issuer is legally required to hand you that cash within 2 business days, period. That effectively standardizes liquidity across the entire digital asset industry.
But here's the part of the OCC proposal that I think is going to cause the most friction out there, the yield ban. The rule explicitly states that issuers cannot pay interest to the people holding these tokens.
Yeah, this is definitely the most controversial piece of the puzzle.
I mean, just think about it from a regular consumer perspective. If I hold my dollars in a traditional money market fund right now, I get maybe 5%. If I hold them in a stablecoin under this new OCC rule, I get 0. Why on earth would I hold the stablecoin?
You've hit on the exact friction point, but you have to realize that is entirely by design. The regulators are absolutely terrified of deposit flight.
Bank runs, essentially.
Basically, yeah.
Yeah.
If stablecoins paid a 5% yield and also had the 2047 utility and speed of crypto, why would anyone keep their money sitting in a regional bank?
They wouldn't. They'd move it all to the blockchain instantly.
Exactly. The regional banking system would collapse overnight. So the yield ban is essentially a regulatory moat designed to protect the traditional banks.
It's a moat, but reading between the lines of the proposal, it also feels like a drawbridge. By banning yield and making the compliance costs incredibly high for these issuers, The regulations are effectively inviting the big Wall Street banks to just take over the sector.
Oh, without a doubt.
Yeah.
JP Morgan or Cities can handle these capital requirements and compliance rules in their sleep. A scrappy crypto startup. Maybe not so much anymore.
And this connects to a massive macro trend we've touched on before. If stablecoins are legally mandated to hold U.S. treasuries to back their tokens, they essentially become a transmission mechanism for U.S. debt.
Look at the long-term projections in the research. The stablecoin market cap is expected to hit $2 trillion by 2028. Under the Genius Act, that entire $2 trillion has to be parked in cash or short-term U.S. Treasury bills.
That is a staggering amount of structural buying pressure for government debt.
It creates a guaranteed bottomless buyer for the U.S. government. It integrates crypto directly into the machinery of the U.S. dollar. It's not replacing the dollar at all. It's reinforcing it globally.
Which brings us to the actual health of that global system. We need to talk about that heavy ceiling holding the Bitcoin price down that we mentioned earlier, Geneva.
Right. This is the stark risk-off reality we are facing. We have all this incredibly bullish news on ETF flows and regulatory clarity, but right now, Bitcoin is trading as a high beta proxy for war risk involving the U.S. and Iran.
Let's clarify high beta proxy for a second for everyone. Essentially, we are saying Bitcoin is acting like a magnifying glass for market fear.
Exactly. It amplifies the broader macroeconomic sentiment. And right now, that global sentiment is pure fear. We are officially in round 3 of the nuclear negotiations in Geneva, and the U.S. has set a very hard, very public deadline of March 1st through the 6th.
A lot of you listening probably ask yourselves the same thing I do. Isn't Bitcoin supposed to be digital gold, a safe haven asset? If a war breaks out, shouldn't it instinctively go up?
In a perfect academic vacuum, maybe, but not in this specific economic chain reaction.
Walk us through the domino effect.
Okay, here is the domino effect the market is terrified of. If there's a kinetic conflict, meaning actual shooting and military strikes, it immediately threatens the Strait of Hormuz.
Which is the massive choke point for global oil shipments.
Right. War means the strait closes, which means an instant oil shock. An oil price spike drives global inflation up immediately. If inflation spikes again, the Federal Reserve completely loses the ability to cut interest rates. In fact, they might even have to raise them.
And high interest rates are basically kryptonite for non-yielding assets like Bitcoin.
Precisely. So the market isn't pricing in a simple Bitcoin versus war scenario. It's pricing in Bitcoin versus the Fed reacting to a war.
That makes a lot of sense.
That is exactly why peace, or at least some kind of temporary diplomatic deal, is the ultimate bull case right now. If a breakthrough happens in Geneva, even a limited enrichment deal, that entire risk premium just evaporates.
The fear leaves the market.
The fear leaves, and that structural coil we talked about earlier, it springs loose and probably sprints straight towards 75,000.
So while we all sit around and wait on Geneva, the crypto exchange landscape is going through its own sort of geopolitical split. The notes frame it as a tale of two Binances.
It really is a stark divide between East and West right now. In Europe, Binance is playing the perfect corporate citizen. They are actively moving their headquarters to Greece to secure a MiCA license, which is the big EU passporting regulation.
Right.
They brought in KPMG and EY for massive audits. They are desperate to look like a boring traditional finance company.
And then you look at their situation in the United States, and it is a completely different movie.
It's basically a financial crime thriller at this point. Senator Richard Blumenthal and the Permanent Subcommittee on Investigations have opened a massive new inquiry. And we aren't talking about slap-on-the-wrist regulatory fines here.
No, the numbers are huge.
They're alleging $1.7 billion in illicit transfers, money allegedly moving to Iran proxies and the Russian shadow fleet.
That is incredibly heavy stuff. And reading the sources, the Senate seems specifically interested in Binance's connection to World Liberty Financial, which obviously has deep ties to the U.S. president's family.
It is an absolute political minefield. They are specifically looking at the stablecoin USD1 and investigating if Binance is essentially acting as the illicit engine for it.
How is the broader market digesting all of this? Because love them or hate them, Binance is still the biggest player on the board.
The market is visibly nervous. Right now, Binance's on-chain reserves are at a 15-month high. Now, normally you might look at that and think, oh, they have lots of money. That's a sign of strength.
But in this context,
In this context, it's a massive supply overhang. It means there are a ton of customer coins just sitting on the exchange, ready to be panic sold at a moment's notice if the regulatory hammer actually drops in Washington.
talk about tension.
Oh,
Well, from one high-stakes situation to another, let's look at corporate treasuries, specifically MicroStrategy. They are now officially the most shorted large-cap stock in the entire U.S. market.
yeah.
14% of their float is sold short. That's roughly $6 billion betting against them.
This is, hands down, one of the most fascinating trades happening in the traditional market right now. And it's really important to understand why hedge funds are shorting it. It's not necessarily that they think Michael Saylor is crazy or that MicroStrategy is going bankrupt.
Right.
It's a pure basis trade.
Let's break down the mechanics of that basis trade because I think it's really easy to get lost in the Wall Street jargon. Essentially, it boils down to the fact that MicroStrategy stock is trading at a massive premium to the actual Bitcoin it holds, right?
Exactly. Let's make the math simple. Let's say the actual Bitcoin held by MicroStrategy comes out to be worth $100 per share of the company. But the stock itself is trading on the NASDAQ at $200 per share.
So it's trading at a huge premium to its net asset value, its NAV.
Right. So the institutional traders look at that gap and say, well, that makes no fundamental sense. The company just holds Bitcoin. So they put on a pair trade. They buy the actual spot Bitcoin to go long, and they simultaneously sell the MicroStrategy stock short.
They are betting that eventually reality sets in and the premium gap closes.
Exactly.
But here's the massive danger in that trade, and it's exactly why I think these short sellers are probably sweating right now. MicroStrategy is a leveraged play. If Bitcoin rallies to $70,000, MicroStrategy stock historically tends to go up even faster and harder than Bitcoin itself.
And that is the trap. If Bitcoin rips higher, the gap doesn't close. It actually widens. And because the float, the actual number of MicroStrategy shares available to trade on the open market, is relatively small, it creates a powder keg.
Because if the stock price goes up, those short sellers start taking heavy losses.
Right. And if they have to cover their short positions to stop the bleeding, they are forced to go into the market and buy back the stock frantically at any price.
A classic short squeeze.
A massive, historic short squeeze. It could send the stock into the stratosphere entirely disconnected from Bitcoin's actual price. And the crazy thing is, despite all this billions of dollars in short pressure, the company isn't blinking at all. They literally just bought their 100th batch of Bitcoin.
Another 592 coins added to the treasury.
They are completely doubling down on the strategy.
Talk about absolute conviction. Wow. Well, before we wrap up today's deep dive, I want to take a look at some of the on-chain detective work from the sources. We have a bit of a good news, bad news situation going on here. Let's start with the good. Who exactly is Wallet 17oka?
Yes. This is a classic whale watch moment. So earlier in the week, when everyone else was panicking about the geopolitical news out of Geneva, the market was dumping, this specific on-chain entity quietly withdrew $249 million in Bitcoin from Binance.
So while retail was panic selling, this whale was just aggressively scooping it all up.
Exactly. And taking it completely off the exchange into self-custody. That is the ultimate sign of long-term confidence. It's smart money buying the fear.
I love seeing that. But then we have the bad news, the Bithumb error. This story in the notes is just, it's painful to even read. Bithumb, the massive Korean exchange, had an internal system glitch where they accidentally credited their users with $40 billion worth of Bitcoin.
40 billion. With a B. It is a fat finger database error on a cosmic scale.
I mean, I get nervous when I send $100 to a new wallet address to test it out. How on earth do you accidentally credit the GDP of a small country to random user accounts?
It is an absolute nightmare scenario for their back-end engineering team.
Yeah.
Now, to be fair and to their credit, they somehow managed to freeze the platform and recover 99.7% of those funds almost immediately.
Right.
But crypto is immutable, and speed matters.
And some of those users were faster than the exchange freeze.
Yes, they were. 125 Bitcoin were quickly withdrawn to external wallets before the freeze took effect, and they are just gone. That's millions of dollars in permanent corporate losses because of a simple database error.
It really reinforces exactly why the big institutional money we talked about earlier strictly prefers the ETF wrapper.
Absolutely. The crypto community can chant, "Not your keys, not your coins," all day long. But for a massive state pension fund, the risk of a Bithumb-style error or an intern losing a hardware wallet private key is just completely unacceptable.
They want insured and audited.
Exactly.
Oh.
The ETF provides that necessary regulatory safety layer.
So bring this all back to the start of our deep dive today. We have the technical breakout reclaiming 68,000. We have the massive institutional backing with the $500 million ETF inflows. We have the strict regulatory roadmap being laid out by the OCC with the Genius Act.
The foundational pillars of the next market cycle are clearly built, but the roof of the house is currently being held down by the Geneva talks. We are basically in a high-stakes waiting game.
You know, reading through all this material, it really feels like the industry is finally growing up, but in doing so, it's fundamentally becoming something different.
That's the reality. The whole era of frictionless, totally anonymous, Wild West crypto is effectively ending. That's the clear signal from the Genius Act rules and the massive Binance investigations. It is rapidly being replaced by a highly regulated, thoroughly surveilled settlement layer that is going to be fully integrated into the U.S. banking system.
Which leaves me with a thought I really can't quite shake and something for you to think about as we wrap up. If the Genius Act legally mandates that all these stablecoins must hold U.S. treasuries, and we know the big Wall Street banks are poised to enter that game and issue their own, we are looking at a future where crypto's primary global use case is essentially funding the U.S. government debt.
That is the ultimate irony of the whole space.
Because if that happens, Bitcoin really stops being a cypherpunk rebellion against the fiat dollar system. It just becomes the battery that keeps the dollar system alive for another century. And that is a plot twist that I really don't think the broader market has fully priced in yet.
It certainly changes the definition of victory for the industry, doesn't it?
It really does. We'll be watching the Geneva headlines incredibly closely over the next few days. Thanks for taking this deep dive with us.
Stay curious out there.